Peter, Jeff, thanks for joining me.
Thanks for having
Good
me.
to see you again, Steve.
Good to see you. We are talking today about some Wall Street firms looking to buy real estate, particularly discounted or stressed real estate assets. They're raising new funds, focusing on office building, apartments, other troubled commercial real estate, including malls. This includes Cohen Streets, Goldman Sachs, EQ2 Exeter, BGO, quite a few funds looking to capitalize on troubled commercial property markets, with values diving in a lot of these areas. The office market's one of the largest sectors they're targeting, but also apartment buildings. We just recently spoke on this topic about some folks using risky models with variable debt, and having some troubles there, and also mall owners that we've previously talked about that are having some problems in some of those traditional shopping malls, and like the new malls we're seeing come exist, take some hits. But want to get your thoughts as we've seen distressed commercial real estate grow to about 8 billion last quarter. That we're seeing folks, at least the smart money, instead of running from it, looking to raise capital to buy some of these distressed assets.
Well, look, Steve, if I may go first, I'll just make a comment. First off, that area of real estate is not something that our firm is interested in, nor is it an area that we invest in. Now, here's where I see the problem. In order to fill those offices, you have to have employers and employees. And in order to fill those apartment buildings, you have to have people who work in those cities and in those buildings. When is a bargain not necessarily a bargain? Now, I don't want to be a judge because we don't invest in those areas. They're not for us. But it's hard to imagine that's going to be a long-term. It is going to be a very long-term investment in order to be successful. You got to have jobs, and corporations are pulling out of the big cities, and they're going to the suburbs, including Ohio, for God's sake. So anyway, that's my comment. Jeff?
I think it's the like our the last video that we had done, which was on Warren Buffett. I think he said, "Be fearful when others are greedy, and greedy when others are scared." Truth of it is, I'm not opposed to the asset classes. I have a model that actually, I'd spoken at length with another partner that was based off of acquiring old defunct mall assets and converting them into essentially town centers, which is a combination of both. It revitalizes the area. I don't think it's a bad play. And to your point, though, I think it just depends on where. Are they large scale? Sears with 90,000 square feet. What are they? But the truth is, I think there's opportunity with a lot of it. There's a lot of money sitting on the side, and I think who better to waste people's money than big investment offices?
Well, I also think that to kind of expand on what you guys are saying, I think one thing we're illustrating here is this isn't for amateurs. It's not for the faint of heart, because you start digging into stuff, and you may find that in New York, actually, or in some other cities too, that the real Class A, the high end spaces, have actually held up in value pretty well. And some
except
of the
for
lower
Hudson Yards,
Yeah.
for Hudson Yards, which is a Class A space, 50% occupied.
Yeah. So just kind of going to the point though of
Sorry.
you really have to do your homework here, or you can potentially really get burned on these things. I think for shopping malls, we kind of talked about this. There's definitely repurpose opportunities there that you can do. Some of this is prime real estate. The move to the suburbs, absolutely. Apartments, we were just talking about some very, issues with variable rate structures with some of these deals. But I think when you start talking about buying distressed or problem assets, you really, really better know what you're doing to be able to value these and get a sense of whether you're buying something that is undervalued, or you're buying something that has been falling because it's still trying to find its real price, and maybe it hasn't hit bottom yet.
Well,
Um,
I mean, to add to that, let's take back to like a multifamily model. If you're buying into 3 cap to service your debt, you've got to be averaging a specific price per square foot or price per unit. If you can buy a defunct asset, maybe you don't have to do it. Maybe you're buying it for under the cost of the dollars that are, the lending dollars that are on it. You probably make it work for a cheaper price per door, price per square foot. But you're right. You do have to understand what you're getting into for sure.
yeah, so I think our advice to be most retail investors or average folks would be to really, really be careful about trying to catch a falling knife. And that this really is a sector where there's some people that know what they're doing, and they've not necessarily deployed this capital. They've raised it, and if they get certain prices that they've targeted for assets that they've targeted, that they'll deploy it. But I think that's kind of this is not for amateurs when it comes to buying distressed or problem properties. This is probably one of the riskiest things you can do.